All right, hello guys. Welcome back to the last part. I tried to cover it as much as I could. So in this part, we are talking about forecasting. And what should we be focusing when we try to forecast. And then we're gonna talk about stress tests and then collateral analysis. More on it later on. But when it comes to forecasting, um, my recommendation is there's certain things that you should be focused on instead of going and try to focus on every kind of items. And when I talk about items, it means every type of this. So when it comes to this, what should we be focusing when we kind of try to forecast for um, 2025, 26, and 27? Something I would look at is I would look at the revenue. I want to see what is the growth rate kind of over time. For instance, if you find the growth rate right here, for instance, is, let's say, divided by that. So let's say the growth rate is 17%. And then you're gonna use the same for this. Then you see this is the growth rate. Maybe you use the growth rate, that average of these two growth rate for 2025, and then keep it the same for 2026, 2027. You could do that for cost of. You probably find a better ways for cost of goods sold, but ultimately you could do that as well. Um, and then ultimately, because you're forecasting these two, you gotta be able to finding gross margin as well, right? But right here, I'm highlighted those things that you should be focusing in forecasting. Um, for these expensive, don't try to spend so much time on analyzing whether it's to go up or down. If you have time, then ultimately the more specific, the better. However, in your presentation, I recommend you to focus on a few things that help support your argument. Don't bring the whole income statement and then explain every line items. Just pick a few things. The next thing I think is important is the interest expense. My apologize. It's because as a lender, you kind of curious to see, are they are they having too much interest that it's become a trouble loan for them? From what I see here, it's not a big fluctuations. So I personally I think it's a pretty good sign that this company is pretty stable, not something to worry. But you still want to kind of forecast out what is the expectations for the interest expense, right? Let's say the Federal Reserves suddenly increase interest rate, or let's say if they decrease interest rate, how is that gonna impact this forecast, right? I'm not gonna spend so much time on these two. On the tax, don't get yourself too confused. Just find some way to do it, and you should be able to figure it out. So I would focus on just these three things. Then you would be able to come to net income and then EBITDA, right? For some of y'all who don't know how to find EBITDA, I recommend going to the website. Going to income statement, scroll down to EBITDA, and then we just copy over. Just do some research on what EBITDA means so that you be ready to answer kind of questions from the judge. But let's say if you don't really know how to kind of forecast each item, it might be too hard for you. Then probably you could just go straight to EBITDA and then try to forecast it. So let's say I'm using the same formula to see the percentage change. Let me see. So I see it's increasing kind of 23%. So maybe you use that same assumption that it's going to grow 22% year over year. You could use that assumption as well. But EBITDA is remember, EBITDA is very important. You kind of want to forecast EBITDA at the end ultimately. When it comes to balance sheet, something that would interesting is you don't have to forecast every line items. However, I would focusing on cash and cash equivalent, cash receivable, maybe contract asset as well, inventory, and properties. Well, net properties and equipment. And ultimately these added together is total asset, right? Uh, the reason why we're interested in this is because later on you will figure out that these are the called collateral. Why is it? Uh, Collateral means that in the case of bankruptcy, then what can you get from the companies? Kind of like a collateral, right? If the company suddenly go bankrupt, then you want to have some guarantees, and these are the guarantees, right? Consider account receivable. Um, it's easy to collect money. Inventory, right? Easy to sell inventory to collect the monies. Um, when it comes to property and equipment, it takes longer to sell that properties. However, it's still um, however it's still something that could help you recollect your loans if the company suddenly bankrupt, right? Um, then when it's come to liabilities, I would focus on forecasting the current liabilities. Don't have to be anything too crazy. If you want to focus, then you could just focusing on the total current asset and forecasting these into the future. You don't have to do every line item over here. Just focusing on this big item and forecast it out. Focus on this big item and forecast it out. Uh, Also the same with total current liability. You don't have to forecast every small items, but just focusing on forecasting that out. What else should you focusing on? This is very important, which is I think is a long-term debt, right? You want to see what is the total debt that they gonna have and they will have in the future. And the reason why is, if you remember, I'm talking about the leverage ratio, which is one of the covenant that put in place. A covenant is just mean a kind of like a term that you require these companies to kind of follow um, when you lend out the loan to them, right? Or another term is restriction, kind of restriction. And if you remember, leverage is equal to debt, total debt, divided by EBITDA. Um, Total debt divided by EBITDA. It's going to be total debt divided by EBITDA. And so that's the reason why forecasting the EBITDA from the income statement and then the total debt from the balance sheet is very important. I wouldn't spend so much on forecasting the cash flows statement, but what else? I say if you don't know how to find a long term debt, um, something you could go to is you could go to the website and go to the balance sheet, scroll down, you would see it say total debt over here, right? Ultimately, like I said, you could copy these number in and then forecast it out by seeing what is the growth rate over time, and probably you could take an average of that. Um, Even more convenient is when we talk about leverage ratios. Uh, you remember, if you go to the ratio section, scroll down to debt divided by EBITDA. You see that? So these are the numbers. Maybe you could forecast it directly from here. If it's too complicated to figure out where things are. So those are the things that I think is important. And let's see. And when on the cash flow statement, I wouldn't spend so much time on this, but if you want to spend some time, then this item right here is important. Net cash provided by operating activity. Maybe you could forecast it out, how it's going to be on 2025, 2026, and 2027, because these ultimately is the money left over after running the companies, after paying for everything to run the companies. These are a leftover money, and with this leftover money, they're going to use it to pay down debt ultimately, right? So let's say if you remember, they're asking to borrow kind of like 250 something million, right? And you want to see if this covered, maybe it's covered a little bit of that, or I leave it for you guys to interpret that. But another thing is you could look at purchase of property and equipment, right? It just show how whether the company is continuing investing in the business. But other than that, I would not go to do anything too crazy. All right, so when you forecast the income statement, the balance sheet, you would be able to find the ratios. You could be able to forecast the ratios, some of the ratios, right? So we just talk about the EBITDA, the debt divided by EBITDA, right? The leverage ratio. Remember, so there's our two leverage ratios. The first is we already talked about. The second one is called the interest. I remember something interest. I apologize. I'm completely blank. Let me see. So it's called interest coverage ratios. So it just means that you see interest expense over there. So what you're gonna do is you're gonna take EBIT divided by interest expense, and that is gonna be the ratios that you're gonna find. And remember, if you don't know how to find EBIT, right, just go right through the website again, income statement, EBIT right here, just use those numbers, see what is the growth rate, then forecast it out. And then same thing for interest expense, right? Interest expense you already have here, you probably already forecasted out already, so you just take the EBIT divided by interest expense. So remember, the two leverage ratios is very important. Make sure that you have those. All right. So when it's come to stress test, give me a moment. Let me double check certain things. Okay. All right. So when it's come to stress test, we want to see how much. So back again. So you guys remember we have these are the two covenants, which means the leverage has to be below 3.25. I'll write that. Leverage has to be below 3.25 leverage ratio, right? And then the interest coverage has to be greater than 3.0. All right, so when it comes to stress tests, you want to see how much increase would make these two numbers be violated. What do I mean by that? Okay, so bear with me. Going back to the Excel sheet, let's say this is the EBITDA that you have, right? And then let's say you forecast in the future for 2025 is it's gonna be this number with the growth rate of 22%. So this is the so I would assume this is the 2025 kind of EBITDA. Okay, so the debt for 2025, let me assume as well, right? I would go to the website again, go to balance sheet, long-term debt, right? So I see I do not have I do not do the forecasting yet, but this is just my kind of assumption. Well, not long-term debt, I apologize, total debt. So this is just my assumption, right? I see probably I think the total debt got to be around. We have to have some calculated numbers, but in this case, I'm just assuming, right? I'm just pretending. So I would say total debt will be around 855, right? 855 is the debt. So I would put, let's say, the debt, total debt, I would say is 855. Okay, I'm just pretending. Don't worry, guys. But I want you guys to see is that, remember, total debt divided by EBITDA. Okay, this should be over here because this is 2025. My apologies. All right, so if you take total debt, you divide it by that, it's gonna give the leverage ratios. So you guys see, it is 2.00 is the leverage ratio, right? And what is the requirement? The requirement is it has to be less than 3.25. So it's actually is follow. But when we come to sensitivity analysis, we want to see is how much. So let's say there is two. You guys remember there's the equation for leverage is equal to total debt divided by EBITDA, right? So you want to see how much increase in total debt would lead to a violation of this, and how much decrease in EBITDA will lead to that. Well, so what combination of total debt and EBITDA would lead to the violation of this, right? So if it's greater than 3.25, it's violated. So it couldn't be bigger than that. But we want to try to see what how much increase would lead to that. Okay, this is a little bit confusing to y'all, right? But hang with me. So let me see. Let me just copy again, right? EBITDA. So this is 2025, right? I just want you guys to kind of see that. Okay. And then remember the total debt forecasted is 85. Okay. And when you divide it by each other, it's called leverage ratio, right? Leverage. Okay, just make it this way so it's okay. My bad. It's gonna be total debt divided by EBITDA. Okay, so maybe you want to see what if it's increasing by 10%, right? What if it's increasing by 10%? Let me show you guys. 1 plus 10. Okay. Okay, and then but total debt doesn't change. You just change the EBITDA. Then what would it happen? What would be the result? So 855 is the same. So you're gonna take the debt divided by EBITDA. So you see it's getting smaller, right? So you want to see in case of, let's say, however, if what happened if it's a negative 10. All right, when it's negative 10, it still follow the rule. It's still less than 3.25. But let's say if it's if EBITDA is less than 20%, it still follow the rule. You guys see that? So if it's let's say if it's 30, it still follow the rule. That is pretty wild how that happened, right? All right, but in this case, you guys see that if it's if EBITDA growth is decreasing 40%, it's gonna lead to a violations. And when it comes to sensitivity analysis, so what we do right there is you creating many range of percentage change, and you see what will be leading to that, how much decreasing of EBITDA will lead to a violations of the leverage ratio. All right, my apologies. Okay, so and that is just talking about the EBITDA side of things. Let's say you want to see what if total debt increase or decrease instead, right? So let's say what if the total debt is increasing by 10%? So what would that be, right? Multiply by 1 plus rate. I did 1 second ago. Okay. So if it's increasing by 10%, the total debt, and this one is fixed. Okay, this one is fixed, right? Because I didn't put the rate for EBITDA. If it increasing by 10%, this one is still good because it's still less than 3.25. But what if it's 20% increase? Still good. 30% still good. 40% still good. 50% still good. 60%, and now it's still good. That's crazy. How about this? All right. So at maybe 65. All right. So at maybe 62. Okay. So maybe 63. Okay. So at 63, it's no long. It's gonna violate the leverage ratios because it's bigger than 3.25. So interesting to me. I think this is I don't know. When there is an increasing, no company would have this dramatic change in total debt increased by 63%. So from what I do so far, I think it is a good sign that this company is pretty it is pretty safe in my sense, in my analysis. But I leave it for you guys. Remember, you guys could also do the same thing for EBIT and interest expense for sensitivity analysis. Of course, I think the hardest part is how do you gonna display it. I leave it for you guys to find the best ways to displacing it. But so far, we talking about these two already. I would touch on last the collateral analysis. When it comes to collateral analysis, I would use Professor Dawson, this page of Professor Dawson. So I would want to let you guys see is that if you go into the discounted assets coverage, so this is Professor Dawson Excel chart. I think this is a very good chart. So remember, these number wasn't there before. So I would just input those number in. You guys should double check if I got the number correctly, but I just drawn it from the balance sheet, and these are just also from the balance sheet as well, right? So account receivable, inventory, PP&E, but it's account payable. All right, you guys kind of remember these are the collateral that we just talked about, right? These just in case of this company wasn't be able to pay us back, then how can we get back our money in that case. So these are the quick assets that we could kind of want to get a guarantee from the company. So um, and down below here, you guys see different type of debt. This is the total debt that the company has. The second one is talking about the debt, the credit card debt that they're asking for. And then lastly, this is the amount that we are contributed to this 215 millions, right? Okay, so just go through itself. Just click on the 521 over here. You guys see that it multiplied with 0.9, and what it means is that usually when we are lending to people, um, if when we take collateral on something, we don't assume this 579 to be the actual amount. We want to be safer. We want to be all right. Maybe your let's say inventory, right? Maybe you store something and we just don't believe that over time it's gonna keep that value. We actually think that it's gonna be around 201. All right, so this is just what it means. It's just devalue these asset a little bit, so that we be more safer. All right, when it's come to margin factor, 80%, 60%, 50%. When we do that is, again, we applying some sort of like, all right, we just assume 20% will not be able to collect. So from account receivable, and then 60%, we believe that we be able to collect it from inventory, but the other 40%, I think it's gonna be lost. So right here, if you click over here, it is multiplying the eligible with 60%, which further reducing the numbers that we originally has. This just shows that we are being more careful in analyzing these collateral. So let's say from before you see 579 is your account receivable, but toward the end we actually value it just as 417. And so if you sum up all that at the end, this is the number that we believe that actually we're gonna be able to collect it back, if just in case the company go bankruptcy, right? And it's not going to be the original amount that you think you got it, but this is the actual amount that we comfortable thinking that we be able to recollect it. Okay, so back to it. You guys kind of remember, if you if you click on these three box right here, you guys see that, right? Something that you will see is that it takes the D13, right, which is the debt divided by the red box up here. I wouldn't care a lot about this 54%. What I would focus on is the middle amount right here, because what it does is it takes the okay, one sec. Okay, what it does is it takes, well, it's still, well, my apologize, it does mean something. So when you take a total amount of debt divided by your total amount of eligible, then you will see that, what does it mean if you take debt divided by this number? It means that 54% of debt is covered by the eligible asset. So I said if it is ideal to have it covered. So even if 54, or even if the smaller the number is, ultimately the better. However, in this case, remember, we, even if it's 90%, it still be positive and not so negative, right? Because it's covered by our collateral. However, the smaller the number, the better. In the middle number right here, you see that it's the amounted the 215 million that the company asking for, and if we divide it, we see that it's only so the collateral cover the whole thing, the 215, and it's only 14% of the total collateral asset. I think this 20% number is important right here because it's actually show us that. So once again, what is the difference between this 14% and 20%? The 14% is using debt divided by the eligible, but the 20% is using debt to divide it by the conservative numbers that we have here that we discussed about. And you see it is 20%. So that, like I said, the smaller the number, the better. However, in here, the reason why you see it's bigger is because we actually consider this number 1059 to be the final total collateral asset that we have. However, regardless, the bigger numbers is not ideal. The smaller the number is ideal, but the bigger number doesn't mean that it's not a good thing. It's still a good thing. Because why? Because 20% is covered by the total collateral asset. So, like I said, even if 80% doesn't mean that it's a bad thing, right? It's just that you want to understand why these numbers are the way that these. All right. So I've been talking a lot. I think it's covered everything that I want to share. Once again, if you have any questions, please don't hesitate to reach out to me, Professor Dawson and Brandon, and we would happy to help you. Thank you so much.